Chevron's 2025 Investor Day revealed a bold roadmap to 2030, one that shifts the focus from pure volume growth to cash flow, returns, and resilience. Today, we're breaking down the key targets, the risks, and whether Chevron can realistically deliver. Chevron's main targets for its 2025 Investor Day include adjusted free cash flow and EPS growth of over 10% annually, assuming Brent crude at around $70 per barrel, 2 to 3% annual production growth through 2030, maintaining disciplined capital expenditure of $18 to $21 billion per year, with $3 to $4 billion in structural cost savings, expanding downstream and new ventures to reduce reliance on crude prices, increasing return on capital employed, or ROCE, by more than 3 percentage points by 2030. Target 1. Cash flow and earnings. Chevron introduced a new metric, adjusted free cash flow, which smooths out one-time items like asset sales or working capital changes. At first glance, the 10% growth target looks achievable, but unadjusted cash flow has actually declined sharply since 2022, in line with oil prices. The target is conditional on Brent at $70. EPS growth depends on modest production gains, cost reductions, and aggressive share buybacks. But any delays in cost synergies, especially from the Hess acquisition, could put these targets at risk. Verdict: low plausibility. Ambitious targets, but highly dependent on execution and integration success. Target 2. Production growth. Chevron aims for 2 to 3% annual production growth through 2030. Major projects in Guyana's Stabroek Block and Kazakhstan's Tengiz Field are central to this plan. Together, these developments could deliver roughly half to three-quarters of the increase Chevron is targeting. Timing and execution are key. Ramp-ups can be delayed, and older fields are in natural decline, meaning smaller projects must step up to fill the gap. Verdict: high plausibility. Strong growth backbone from Guyana and Tengiz, but timing and legacy field declines remain risks. Target 3. Capital expenditure. Chevron plans to spend $18 to $21 billion annually, including both organic investments and affiliate projects. ExxonMobil-operated Stabroek projects carry low execution risk, providing a solid growth backbone. But Chevron-operated projects, like Tamar Phase 2 and Leviathan in Israel, carry higher risk due to Chevron's historical record of overruns and delays. Verdict: medium plausibility. Disciplined CapEx is achievable if non-operated projects perform, but operator-led projects are higher risk. Target 4. Cost reduction and efficiency. Chevron aims for $3 to $4 billion in structural cost savings by 2026, leveraging Hess acquisition synergies and operational simplifications. While the $1 billion synergy target is clear, overall efficiency gains are ambitious and rely heavily on execution. Verdict: low-medium plausibility, achievable if integration and operational discipline deliver, but past performance provides limited precedent. Target 5. Portfolio resilience. Chevron is diversifying beyond upstream crude. Downstream contributes roughly 25% of earnings, helping buffer against oil price swings. Early-stage AI and data center power projects, like natural gas-fired plants in Texas, aim for predictable revenue by 2027. However, until those plants are operational, the majority of earnings still come from upstream operations. Verdict: low plausibility. Diversification provides some buffer, but full insulation from commodity swings is still years away. Target 6. Return on capital employed. Chevron targets a more than 3% ROCE improvement by 2030. Higher profits, debt reduction, and share buybacks are the main levers. While achievable, execution risk is significant. Verdict: medium plausibility. Profit growth drives return on capital employed, but timing and execution remain the key constraints. In summary, Chevron's 2025 targets are ambitious. Production growth looks achievable, but free cash flow, EPS, cost synergies, and return on capital employed hinge on disciplined execution and timely project delivery. Diversification into downstream and new ventures adds resilience, but upstream performance will continue to dictate overall success. If you found our video useful, consider subscribing to Decoder Insights. You can also find our deep dive analysis at this link. Thank you for watching.